Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome. This is All You Need to Know. I'm Agam Vakil. Let's start by taking a look at global indices, and we have seen a lot of weakness across. Starting off with the US markets, a drop of 3.8% for the Nasdaq and 3% cuts for the S&P 500 as well as the Dow Jones. And that's evident in the European markets too, the weakness that we've seen. Cuts are not as deep as the American markets, but it's certainly showing up in some of these Asian indices. So the Nikkei is also trending lower by around 1%. Hang Seng down by around 1.5%. It's had an impact on the SGX Nifty as well, considering that is trending lower by around 0.5% at this point in time at around 10,862. But when it comes to our own markets, again, marginal movements, a very range-bound trade. The Nifty, well, declining marginally. Mid-cap and small-cap indices also moving largely in tandem with the benchmark indices. The Nifty banking indices, however, did see weakness, specifically the PSU banking index. But among other sectoral indices, we did see strength in the Nifty IT index on the back of the weakening rupee against the dollar. And Nifty Pharma, of course, well, showing flattish movements too. But when it comes to your ADRs, we've seen Tata Motors, Vedanta and ICICI Bank decline in trade, considering the markets gave away. And of course, among two counters, which saw marginal green, well, Dr. Reddy's and Wipro advancing to a certain extent, not much, but FIIs, of course, sold stock worth 56 crores on a net basis. DII sold stock worth 521. It was a very quiet day of trade, as I was suggesting. The gross numbers are also very small. TCS and Infosys, of course, led the gains yesterday. On the other hand, what was bearing down on the indices was the HDFC Twins and SPI. Now, in futures and options, again, there wasn't too much to speak for. It was perhaps the calm before the storm. 1.2% added in open interest very early on in the series, and the Nifty banking index also continuing to see unwinding very early on in the series, and that perhaps indicates that a lot of traders out there are hesitant to take positions before the big events coming through. Now, your open interest distribution hasn't really changed. The base is still at around 10,500, considering that's where you have substantial amount of open interest in the 10,000 put. But in changes in open interest, what we've really seen is the 10,700, 800, 900, seeing a lot more accumulation in puts coming through. But moving on, the India WIX did come off to a certain extent, but it is still above the mark of 18, and that remains crucial. The Nifty put-call ratio really didn't change. It's at around 1.7. The Nifty banking put-call ratio, however, has come off further from the neutral level of 1 to around 0.9. And in terms of stocks, we're keeping an eye on Indiabulls Housing Finance, which saw short covering. We also saw longs unwind in Torrent Power, considering a drop of 2.5% there. Moving on, we also have Bosch, which saw fresh shorts, considering a 3.6% decline in its underlying, and we've seen fresh longs building up, considering in SRF, considering a 12% build up of open interest in its future. So very mixed hues coming in. And we're going to have to wait and watch for a whole host of events which will influence the markets. But with that, let's go across to David Inglis and Rashad Salamat for the top international headlines.
Let's have a look at the Australian dollar here. So the economy actually fell more than expanded less than expected here in the quarter through September due to sluggish consumption and this decline in commercial construction. GDP rose 0.3% from the previous period, half of what economists were actually penciling in here. So year on year, the economy grew 2.8% below the estimated 3.3% rate.
Britain's ruling Conservative Party faces deep divisions after Theresa May suffered a string of parliamentary defeats on Brexit. The Commons finding the government in contempt for refusing to publish legal advice on the draft divorce, and an attempt to have the contempt motion postponed indefinitely was also defeated. The Prime Minister is fighting for her political life, with her bill facing opposition on all sides.
Now,
I ask them to think. I ask them to think what it would say to the 52% who came out to vote leave, in many cases for the first time in decades, if their decision were ignored. What would it do to our politics?
Now let's get to France. The French government blinks first in this battle with protesters over fuel hikes and the cost of living. President Macron has long prided himself here in sticking to his guns, even as his critics multiplied. But he's now reversed course and suspended this rise in fuel taxes for at least 6 months. The decision raises new questions about the president's list of social and financial reforms planned for next year.
We want, within this 6-month time frame, to identify and implement fair and efficient measures on fuel. However, if we can't agree, we will deal with the consequences.
Iran has again threatened to close the Straits of Hormuz if the United States shuts off its oil exports. President Rouhani saying no crude will leave the Gulf if Washington goes through with sanctions. Almost a third of all seaborne traded oil passes through this narrow strait, and the U.S. has several warships in the area. President Trump has said that he's willing to negotiate, but Tehran has rejected the offer of talks.
Yep, Global News 24 hours a day, on air and on TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. There's lots more ahead. We're just getting warmed up. This is Bloomberg.
The government lost 3 votes in one day in Parliament. And one of the things that happened is that it was actually held in contempt by Parliament. And that was over the Parliament's demand that Theresa May's government give the notes from the Attorney General about its legal advice on Brexit. She'd wanted to withhold that, and finally has now agreed, after being held in contempt, that on Wednesday she'll give those notes over. But it's not looking good for, as you said, the December 11th vote. There's several more days of debate coming up, so we'll see. But it's hard to see anything changing between now and then that would suddenly result in a positive vote on this deal.
No wonder we got such a big reaction on sterling falling for a fourth session. What would this mean for the economics of Brexit?
Well, it's the chance of a disorderly no-deal Brexit keep going up, just because neither side seems willing to back down. The people in favor of Jeremy Corbyn is saying this is not the deal that the British people wanted. We don't accept it. And as we just showed on Bloomberg TV, Theresa May is saying if we reopen this thing, it could go in the opposite direction from what you're asking for. So there's such a wide gap here that obviously a no-deal Brexit would be the worst outcome of all, and yet it can't be ruled out.
I just ask those colleagues who wish to reopen the withdrawal agreement to recognise that were the withdrawal agreement to be reopened, it would not simply be a question of what the United Kingdom then wanted to change. It would also be a question of enabling others to change elements of that withdrawal agreement.
What we said in Abu Dhabi is that projections are that there will be 1 million barrels of oversupply, and that we will wait until we get to Vienna and ascertain what that number is. And the next, I think, road to cross is whether all countries are willing to come on board and contribute to that cut.
There's more bad news when it comes to Tata Motors, as a global ratings from the S&P Global has downgraded the long-term credit rating of the company to BB-. Now, this is the second such downgrade that the company has seen in the last 5 months, citing poor weakness in the profitability of JLR. Also, we'll be watching out for Interglobe, which has announced the appointment of Ranjan Datta as the principal consultant to develop a plan, or to develop a 5-year business plan as it seeks to expand
expand its global presence. Also, we'll be watching out for Hinduja Global Solutions, as the company plans to double down on its expansion plan in Scotland, wherein the company has said in its press release that it would create some 115 new jobs and invest over the course of 2019 at its site in Selkirk in Scotland. Kridan Infra would also be in focus after the company's subsidiary has received an order worth close to 105 crore rupees for a highway project in Maharashtra.
Many analysts have pointed out there's a sea change in the environment against which the October MPC review was conducted and the December MPC review will be conducted. So cut the MPC a bit of slack on some changes in analysis because the environment is entirely different. Let's look at some of the swing factors. Most importantly, it's going to be crude oil. If between the August policy and the October policy, crude oil was up 15%, since then it has tumbled down 20%. Who could have predicted that, right? So the concerns on higher crude oil prices feeding into inflation, those will be to a touch on the back burner right now. Same story, similar issue on the rupee. The rupee, which had depreciated to record lows between the August policy and the October policy, has now appreciated and is trading at about 70, which people believe is a comfort level. But again, the concerns about imported inflation, some concerns about interest rates being used as a lever to tackle the current account deficit, all of those sort of chatters, again, at the backdrop this time around and not as important for the MPC to be looking at. Of course, their mandate is inflation, so a lot of attention will once again be focused on inflation. But here again, there is a change in the environment because you have continued to see inflation underperform expectations. Food prices have remained one big conundrum as to why food prices have been so soft, but what that has done is kept the headline inflation in check. Now, granted that the core inflation numbers remain elevated, but remember, in the inflation targeting regime, you are targeting the headline inflation. So to what extent can you sort of justify acting on behalf of core inflation? That's something that remains to be seen, how the MPC actually justifies it, should it feel the need to continue acting on the inflation front. But at headline 3%, I don't think anybody believes that another rate hike is required. Also, you've got another round of GDP data, and that too has told you that growth from an 8.2% print has come down to 7.1%. So keep all of those factors in mind, and you know that there is very little reason to believe that there will be another rate hike, not just this time around, but at least going by the factors that we have at our disposal right now, anytime in the next few months. So no surprises that most analysts on the Bloomberg poll are suggesting a hold call. There is some talk that perhaps the MPC needs to move back to a neutral stance, but nobody believes that it will happen this time around. Should the factors that we highlighted remain very dovish, then maybe in February or so there will be that debate about moving back to a neutral stance. But it could be a fairly uneventful policy this time around from the perspective of monetary policy. Liquidity is the other thing that has been talked about in the run-up to the policy. But again, if you look at the absolute end of this chart, in the last few days, liquidity conditions have also eased. The RBI has said it will continue open market operations, 40,000 crore to be infused via open market operations in December. They've been putting out calendars, so they've been communicating to the market as well. And the fact that they put out a calendar for December now makes it less likely that a cash reserve ratio cut is on the table. There was some chatter that that may be something that could be discussed, but it looks relatively unlikely. That's on the monetary policy front, so expect a fairly uneventful policy in some ways, although of course there's a whole host of other issues that we will be hoping to hear from the RBI management on.
A SEBI panel comprising of Ranu Vora of vendors, Cyril Shroff of Cyril Amarchand and Mangaldas and others have recommended direct listing of Indian companies on overseas exchanges. The committee, which met since June this year, has recommended that Indian companies incorporated in India can list directly on an overseas stock exchange without listing in India. Currently, the regulations are very strict with respect to listing in overseas jurisdiction, because any company seeking such a listing requires to list in India first and then go ahead and list in an overseas jurisdiction there. The panel has identified 10 countries comprising and the exchanges belonging to those countries as eligible jurisdictions to begin with. These include some of the prominent ones in the US, like NASDAQ and NYSE. In Asia, you have Hong Kong, Korea and Japan. In Europe, you have Luxembourg, you have London Stock Exchange, and others. To begin with, and then gradually the panel may, or SEBI as a regulator, may expand the jurisdiction if required. As per the committee recommendation, the committee has asked the Bank of India to ease some of the regulations with respect to pharma, which does not allow an overseas resident to invest in Indian companies unless the company is listed in the Indian jurisdiction. It has asked a similar exemption from the Ministry of Corporate Affairs to allow listing of these Indian companies in an overseas jurisdiction as well. As far as the beneficial ownership is concerned, the panel has recommended that those should be followed as applicable to the respective jurisdictions. So if a company is listing in the US, then the beneficial ownership disclosures standards should be similar to what they would be following in that jurisdiction, and that should be complied and disclosed in India as well. In the issue of taxation, the committee has recommended that there should be some clarity which should come in from Department of Revenue, and that's where the government role comes in. These entire recommendations are up for public scrutiny and comments, and post that the regulator, the Reserve Bank of India, the Finance Ministry and the Ministry of Corporate Affairs will have a final say on whether to go ahead and allow direct listing in overseas jurisdiction.
It is time where Indian companies in newer emerging areas, specifically digital, internet, technology, they have global aspirations, they have scale they want to reach, and they have to access the lowest cost of capital. So with all of those requirements and to compete effectively in a global market, we thought it would be good, rational economically for such companies to consider getting listed overseas in permissible jurisdictions. And these permissible jurisdictions have been chosen thoughtfully with a reason. They have, of course, high quality capital market infrastructures. They have good KYC and AML practices which are justifiable, and also these are markets where there is a pool of investors who have an understanding of some of the sectors.
The possibilities that open up with direct listing of shares both ways really takes the intellectual basis of opening up the capital markets to another level. As Ranu mentioned, it has in the past been essentially around depository receipts, whether they be ADRs, GDR outside or IDRs over here. And this crosses into the next threshold of direct listing of shares, and consequently opens up a much wider avenue of potential investors, and is also a hallmark of quality for the standard of regulation in the market. So once this finally goes ahead with all the bells and whistles being tied up, it would be huge in terms of the natural evolution of a big capital markets like ours.
Kesoram Industry makes its second biggest move to pare its debt by demerging its tire business. So basically the company will demerge its business into Birla Tires, which will remain listed, and the company also states that January 1 will be the appointment date for the business spin-off. Birla Tires will issue 1:1 equity shares to Kesoram Industries at a nominal value of around 10 rupees per share. The turnover of the demerged business stands at around 1453 odd crore rupees, and the percentage of turnover segment-wise, the tire business contains around 39%. This is as per the annual general report of financial year 2017-18. The rationale for this move is to revitalize the product portfolio and to leverage positive brand equity of Birla name for the new demerged business. 2 years ago, company had sold its tire plant for around 2,000 odd crore rupees and to reduce its debt, which had stood at a staggering 5,300 odd crore rupees. But will this move change the credit profile of the company? Only time will tell.
On the big brokerage calls for the day, first we have is ICICI Direct on Phoenix Mills. Now the brokerage has initiated coverage on the stock with a buy rating and a target price of 775. Now Phoenix Mills, who is a market leader and owner of Prime Malls in India, is a unique proxy play on Indian retail industry, says the brokerage. Now, according to the brokerage, the company's retail portfolio is expected to double, which would lead to a 14% annualized growth in its rental income over the next 5 years. Now, for such kind of growth, the company is well funded on the back of its alliance with the Canada Pension Plan Investment Board and on the back of strong internal accruals, say the brokerage. Lastly, the brokerage says that the current valuations of the company does not value its expanded product portfolio, and on the back of this, the brokerage has initiated this buy rating with a target price of $775 for Phoenix Mills. Second, we have a CLSA on Cadila Healthcare. Now, the brokerage has upgraded the rating on the stock to buy from outperform and has hiked the target price to $430 from $410. Now, according to the brokerage, complex product approval cycle remains strong for Cadila, which would enable Cadila to witness a high single-digit growth in its base business. Now, Cadila has been developing vaccines and biologics for India and other emerging markets over the last few years, and going forward, monetization of these would generate an incremental revenue of close to $500 million for the company over the next 5 years. Now, for long-term view, the acquisition of Heinz is likely to augment the current product portfolio of Zydus Wellness and strengthen its consumer business position, says the brokerage. Lastly, the brokerage has upgraded the rating on the stock to buy on the back of cheaper valuations, which have turned the risk-reward favorable for Cadila Healthcare.
Now, if you've subscribed to Bloomberg Quint's WhatsApp service, you've probably read all the top news over the course of yesterday. Going to today as well, you'll find all the live updates on that WhatsApp service. If you look up the website, though, and in case you've missed any of those stories, you'll find some interesting ones. First up, Bloomberg Quint has gotten access to the resignation letter R. Chandrasekhar sent to Yes Bank. In it, he said, and I quote, "I have been deeply concerned about recent developments at Yes Bank and dismayed at the manner in which they have been dealt with. It is even more distressing that all this should have occurred during a critical transition period when tact, wisdom and purposeful, well-considered actions were called for," unquote. Do look up the website for the full story. The government-appointed board at ILNFS has plans to slash 2/3 of the jobs across the group as it aims to revive the systemically important conglomerate. Axis Capital's Chief Executive Officer and Managing Director Dharmesh Mehta has quit to apparently pursue other interests. The board has elevated Salil Pitale and Chirag Negandhi as joint MDs and co-CEOs with immediate effect, subject of course to approval from the regulator. That's all you need to know going into trade today. Up next is Indian Open, so do stay tuned. This is Bloomberg Quint.